3, 2, 1, 0, and liftoff. Liftoff. Americans return to space as Discovery clears the tower.
Welcome back to TTMTrades. Today, I know a lot of people have asked me to do videos on different indicators, oscillators, the RSI, CCI, volume, all of these different things. But I don't want to jump into those because those are more advanced lessons and or topics. So I want to stick to a basic lesson that I think every trader needs to know and understand, whether it's a amateur trader or a professional trader, right, or an experienced trader, right? And I believe a majority of experienced traders understand this, and it helps them become a better trader. But I believe amateur traders need to understand this also. Again, we're up to 2.1 thousand followers, so hey, I deeply appreciate every single one of you, and let me, for allowing me to continue to add value to your trades. Okay. Before we get started, first and foremost, I just want to shout out Investopedia, because a lot of the information I got was from their website, and a lot of the information, as I was learning how to trade on my own, I pulled a lot of information from this website, and it helped get me kick started. So definitely a good website to have in your bookmarks if you're a new trader trying to learn. So lock that in. All right, so today we're gonna be learning about trading with stage analysis. Okay, the 4 phases of a market cycle. All right, now as you can see, stage 1, stage 2, stage 3, stage 4. Okay, these are the 4 stages that every stock goes through. All right, stage 1 is known as the accumulation phase, and then you have stage 2, which is known as the markup stage, which is where you get your breakout and the uptrend. You have stage 3, known as the distribution stage, also known as the top. And then you have stage 4, which is the markdown phase, which is where you get the breakdown, and then a downtrend. All right, and then it rinses and repeat, and then you go right back into the accumulation phase. All right, so it's very important that amateur traders or new traders understand these 4 stages. It is very important to understand these 4 stages. So moving into it, so the 4 phases of a market cycle. All right, market cycles move in a repetitive nature when it comes to trading stocks, and professional traders know prices move in trends and are not random occurrences. Simply explain, the market goes up, peaks, goes down, and then bottoms. The issue is most inexperienced traders, retail versus smart money. Okay, retail traders will be your everyday traders at home trading from their laptop. Smart money traders are those traders who are trading for hedge funds and big corporations and helping them get gains as far as their company goes. Okay, but the issue is most inexperienced traders fail to realize markets are cyclical and are unable to identify what phase they are in. Another significant challenge is, even when you understand the existence of these cycles, it is nearly impossible to pick the top or bottom of one. Nonetheless, an understanding of the cycles is essential if you want to maximize gains when trading, because each stage generates a variety of trading opportunities that capitalize on current conditions. Keep in mind the price dynamics within this continuous cycle of bottoms, breakouts, uptrends, tops, breakdowns, and downtrends are time frame independent, meaning they work equally well on intraday, daily, weekly, and monthly time frame charts. These are the 4 major cycles more in depth. So I just want to touch bases on this. You will see these 4 cycles on every time frame. So for intraday traders who are making short gains on small movements, they will see the same cycle. People who are trading on a more short to medium term basis, they will see this on the daily and weekly charts. Those who are trading on a more long term time frame, they will see this on a monthly chart. Okay, so you will see this on every time frame. And here's an example. Accumulation phase, you get the breakout, which begins the uptrend, which is the markup phase. You get the stage 3, which is the distribution phase, where it tops out, and then stage 4, which is a breakdown, which moves into a downtrend, also known as the markdown phase. Now, I actually pulled up some charts from recent price action because I hate when people give examples and they give me examples from 1952 or 61. You know, give me something that's happened recently, something I can relate to. Okay, so as you can see, this is the BPMX chart, which just happened here in the month of, I put 2018, but the year 2019. So stage one, bottoms versus accumulation. This phase occurs after the market has bottomed, entering the base building process, and early adopters, also known as smart money managers and experienced traders, begin to buy, figuring the worst is over. In this phase, prices are very attractive and the overall market sentiment is still bearish. Amateur traders that got trapped or bought in during the wrong phase have recently given up and sold the rest of their positions. Prices have begun to flatten, mostly moving sideways in a range, and for every seller throwing in the towel, someone is there to pick up their shares at a healthy discount. Be careful buying early in the base building process because the crowd replacement dynamic can trigger complex testing of highs and lows before support is finally established. Accumulation tends to speed up near the end of the pattern, triggering a set of higher than average volume spikes, which demonstrates enthusiastic buying interest. The overall market sentiment begins to switch from bearish to neutral. So we'll talk about some of these things. Prices have begun to flatten, mostly moving sideways in a range, and for every seller throwing in the towel, someone is there to pick up their shares. So as you can see, BPMX was on this nasty downtrend, and then it finally gapped down. Okay, so as you can see, the price action began ranging, and for every seller who got trapped up here and just decided to go ahead and sell their shares and take their losses, there were buyers who were coming in at these price ranges and saw, hey, this is a decent price range for me to buy in. It has to be a pretty safe area. The prices already dropped, I mean, below the dirt. How much lower can it go? So this has to be a good area to buy in. And you can see the stock begins trending sideways. So as it says, be careful buying early in the base building process because the crowd replacement dynamics can trigger complex testing of highs and lows before support is finally established. So as you can see here, even though it gapped down and it hit 11 cents, it swung back up to 13.5 cents. And then as it came back down to test that 11 cents, it held above it pretty well, but then it came down a little further and then tested that 10 cent. Okay, so it just says be careful. Just because it gapped down and there was some accumulation behind this move, that doesn't necessarily mean that that's the bottom. You have to give stage one time to develop as far as establishing what its resistance is and establishing what its solid support is. Once you're able to identify that, because you gave stage one time to identify those two, then you can start looking at possibly making an entry. Now, if you're a little more riskier and you want to try to catch the bottom, which a lot of people tell you do not catch falling knives, then that's on you. But just know there's a lot of risk in doing that, and just like there's a lot of risk in doing that, there's a lot of reward in doing that at the same time. So it really just depends on you and your style of trading. Okay, now accumulation tends to speed up near the end of the pattern, triggering a set of higher than average volume spikes, which demonstrate enthusiastic buying interest. So as you can see, as it had that dip down, the volume down here was pretty low as it was doing some soul searching, trying to identify support and resistance. Once that was established, then you can see the volume began to spike up, showing that there was some interest and buyers were beginning to come in and accumulate in this price range. As you can see here, volume spike up here, another volume spike up here. Okay, which is showing you that as far as stage one, an end to stage one is possibly you're nearing to the end, because there's accumulation and buyers are beginning to come in and buy at this different price range. Okay, so that's pretty much stage one in a nutshell. Okay, now keep in mind, a lot of smart money managers and experienced traders try to identify this area and they try to buy into this general area because you know what stage comes next, stage two. Okay, now if you can, a lot of experienced traders, when they can identify this area and they can make a good entry, then their risk to reward ratio For one, the reward ratio is definitely greater because you're already at bottom. You've identified bottom and you've bought at the bottom during the accumulation phase. So there's nowhere to go theoretically but up, right? So just be mindful of stage 1. Now, moving on to stage 2. All right. Now, stage 2 is the markup breakout uptrend phase. Okay, so at this stage, the market has been stable for a while and is beginning to break out and move higher. Okay, now we're looking at the chart HEB for 2019. I don't know why I kept putting 18 on it. Sorry. So as you can see here, as it says for stage 2, uptrends occur in this cycle in which market participants can buy aggressively, which in turns attract a small group of committed buyers in the beginning and a big group of weak-handed chasers and followers closer to the end while prices are making higher highs. When the trend momentum is increasing, we can expect the trend to continue. The price action may continue with the trend or enter a reversal. More often than not, the trend will continue after a test of past resistance and support. Okay, so what do I always tell you all? Old resistance should become new support, and old support should become new resistance. So in a matter of breaking out, even if you look at ticker head, right, where you see these highs were created at around 42 and 39 cents, so on and so forth. If you look during this accumulation phase, this is phase 1, looking at this, okay, when you had the breakout, the markup cycle, breakout uptrend cycle, as it pulled back to test, it tested these old resistance areas. So if I was able to draw a line straight across, you would see that the price action came back to test this area to make sure that the trend was still intact, and then it tested that area and came back up. Okay, so this is what they're talking about when they say more often than not the trend will continue after a test of past resistance. Okay, in the context of a stock breaking out. Now, rectangle patterns represent price consolidation, and here we'll zoom down to ticker acre this year, 2019. Rectangle patterns represent price consolidation and can happen when stock shares are being accumulated or distributed during a test of past resistance / support. Now, as prices begin to level off or as the rise slows down, those traders who missed the first breakout and have been sitting on the sidelines see this as a buying opportunity and buy in at large numbers, replacing old sellers with new buyers. As this phase matures, more traders jump on the bandwagon as fear of being left out and greed takes over. So if you look at ticker AKER, which has been running the whole year of 2019 thus far, you know, you have phase 1, you had the breakout, okay, and then you had this sideways rectangle pattern, as it says here. Rectangle patterns represent price consolidation. What is price consolidation? All price consolidation is people who got in this general area, when it hits a certain point, they're taking profits. It only makes sense, okay, if you as a trader got in down here around this 13 to 15 cent range where this consolidation pattern was at during phase 1, and then the stock broke out and then it hit a high of 30. Think about it. Think about that. That's 100% return for you as a trader. It only makes sense psychologically for these traders to take profit in this area. So when they take profit, guess what happens? It pulls back. Okay, now when it pulls back, guess what it tests? It tests that old line of resistance as support. Once it tested it and the shares were bought up and it held in this channel, then it showed that the overall trend was still strong. And during this consolidation period, all you have is people who bought in this area, old buyers who have now become sellers, getting rid of their shares to lock in profit. And you have all the buyers who missed out on this first wave. Now they're coming off the sidelines, piling in, accumulating their shares. And as they buy their shares and hold, they're creating a new support because they're not selling below this line. They're holding. Hey, I bought in at the new low. per this pullback, I'm not going to sell my shares unless something fundamentally changes about this trend. So they're holding. So what does that do when you hold your shares? Then that causes all the other traders who come in last minute and try to pile on top to buy at higher prices and push this up again. And then again, pulls back, okay, retest this old resistance here, finds it as support. You have consolidation again, then you have another breakout. All right, and then again, it's pulling back. Guess where it tested? Right here. And this is recent. This is last week price action. Guess where it tested? Tested this old line of resistance, found it as support, and then gapped up. So when you can identify these things, then it'll help you make better entries and exits on your stocks. Okay, like it says right here, those traders who missed the first breakout and have been sitting on the sidelines see this as a buying opportunity and buy in at large numbers, replacing old sellers. These guys who got in at the low, guys or girls, excuse me, who got at the low, replacing old sellers with new buyers. This is why you get a consolidation pattern, because the old traders are getting out of the way, and all the new traders who missed out are piling in. Again, these traders right here who bought in at that 23 to 26 range, guess what? When it spiked up in here, they got anywhere from 100 to 200% return. Of course, they're going to take profit, and when they take profit, guess what happens? It pulls back. And then all the people who missed this wave are like, man, this stock is still going. So as they're selling their shares, old sellers, new buyers are coming in and saying, hey, we'll accumulate these shares. They're buying them, they're holding them, and it keeps causing this trend to push up. Okay, so that's the markup breakout uptrend. Okay, now another thing you should keep in mind, as this phase begins to come to an end, the late majority of amateur traders jump in and market volume begins to increase substantially. At this point, price action, let me get this right. At this point, price action climbs well beyond average measure, and traders' logic and reasoning take a backseat to their greed. While the late majority of amateur traders are getting in, the smart money managers and experienced traders are unloading their shares to them. Prices make one last parabolic move, known in technical analysis as a buying climax, when the largest gains in the shortest period often occur, but the cycle is nearing the top of the trend. Sentiment moves from neutral to bullish to downright euphoria during this phase. So what does that mean? All right, so let's look at what a buying climax is. Okay, one of the clearest signals of the end of a bull market is a buying climax, during which volume escalates to extreme levels and bullish euphoria permeates throughout the stock. Okay, a buying climax is pretty much the key trait of a buying climax is the exhaustion of demand as the last buyers enter the market. The final surge of buying typically leads to price spikes, which may last for days, weeks, or months. As demand wanes, prices can go into steep declines as sellers attempt to unload positions in the relative absence of buyers. So let's look at ticker JAGX, and this is on a 2-hour time scale. Okay, so each candlesticks represents 2 hours. So JAGX was consolidating in this pattern, give or take, for a month and a half. Okay, and it stayed in this channel of 13.5 to 15 cents for the longest. When it broke out, okay, that's a very bullish signal. On this breakout, this volume spike right here was 7.7 million shares on the breakout. When that breakout happened, I know there was also some news behind this, but technicals along with news, when you have this breakout and all the buyers and or traders who've been watching this stock seeing that it broke out, plus the news, what happened on the next 2 hour time block was this crazy spike all the way from 18 cents to 44 cents in 1 2 hour time block. Okay, and that volume spike was 86.1 million shares, which is a parabolic move, also known as a buying climax. I titled that wrong, excuse me. Okay, so you go from 7.7 million shares in 1 2 hour time frame to 86.1 million shares in the next 2 hour time frame. That's literally a 79 million share volume difference in 2 hours. That is a buying climax. So normally when a stock goes up, okay, you'll have buyers who come in, right, hold their shares and then other buyers will come in and push the stock up, and you'll get a nice little volume spike from people taking profits, so on and so forth. And then the stock will pull back, and then it'll run up again, and then you'll get another volume spike. And as you can see, the volume gets higher with each increase, okay, showing that fresh buyers are coming in on each run. Again, consolidation, another breakout, a higher volume spike to show that all these old buyers who got in back here and sold, they're coming back in to buy this pattern again along with new buyers, okay? And it's a steady trend back and forth to show that the trend is steady and buyers are coming in and they're buying shares at a steady pace. Anytime you get a move like this, a buying climax, when you go from 7.7 million shares to 86.1 million shares and a large volume spike like that, what happens is every single bullish trader, buyer, investor, or whatever, they all pile into the stock at one time. And when they all pile into the stock at one time, they exhaust themselves. Pretty much they've all piled in at one time, which means there aren't any other extra buyers on the sideline that are willing to come in behind them and buy on top of them to continue pushing the price action up. Okay, they all literally piled in at one time. So instead of the stock steady going up inch by inch on volume, going from 13 to 18 cents on 7.7 million volume, then the next 2 hour block going from 18 cents to 24 cents on maybe 13 million volume, and then the next 2 hour time frame going from whatever 24 to 34 cents on 14 million volume, to show that new fresh buyers are coming in with every 2 hour time frame, and that the buyers are coming in steady to continue to push this stock up at a nice steady pace. They all piled in at one time, and that causes a buying climax, because when you all pile into a stock at one time, then that doesn't leave any room for other buyers to come in behind you and accumulate shares. And me, if I'm on the sideline and I miss this move, I'm not going to come in behind you and start buying in at 44 cents. I'm not. So I'm going to sit on the sidelines. And if I'm sitting on the sidelines, there are a lot of other traders and buyers who are sitting on the sidelines too, because they're not buying at the top of that. And so what happens is all the buyers who piled in this area, let's just say from 30 to 44 cents, and they were looking to make a profit, hopefully because they thought somebody was going to come behind them but buy from 44 to higher. Once no other traders came in behind them to continue the trend up, then it starts a wave of selling, and then people begin to start selling their shares. And then if I see this begin to pull back, and I bought in down here or down in this area as a trader, and I see this begin to pull back, now I'm gonna start selling my shares to try to lock in profits. And it's like a domino effect. A lot of selling, and the price begins to break down. So that's a buying climax, okay? And you normally see this at the top of a lot of uptrends, okay? So you'll either see a buying climax, or you will see a new high on lower volume, showing that there wasn't that much buying interest in that high, and then it will begin to fail and you'll start a downtrend, okay? So I hope I didn't go too in detail with that one, but that's stage 2, the markup breakout uptrend phase, okay? Now moving into stage 3. Now stage 3 is the distribution top phase. So in the third phase of the market cycle, sellers begin to dominate. The shares are being sold over a period of time, as the sellers want to maintain higher prices until he or she has sold their shares. This part of the cycle is identified by a period in which the bullish sentiment of the previous phase turns into a mixed sentiment. The distribution phase can come and go quickly, or prices can often stay locked in a trading range that can last a few days, weeks, or even months. There's no perfect time frame for the completion of a top, making it easy to get caught in a poor risk to reward scenario, especially with short sales looking to profit from a breakdown. When this phase is over, the market reverses direction. Classic patterns like double and triple tops, as well as head and shoulder patterns, are examples of movements that occur during the distribution phase. A mature top tends to lose elasticity, with price bars failing to reach the upper half of the range. This limp price action exposes waning interest by the few enthusiastic buyers left in the system, in turn allowing gravity to take control. Intermediate moving averages start to align with key support levels. adding energy to the subsequent breakdown. This phase is a very emotional time for the market, as traders are gripped by periods of complete fear mixed with hope and even greed, as the market may appear at times to be taken off again. Usually sentiment slowly but surely begins to change, but this transition can happen quickly. Those who are unable to sell for a profit settle for a break-even price or a loss due to panic selling. So if you look here on ticker AMRS, you know, you had the markup breakout uptrend phase 2, and then as you moved into stage 3, this is the market top. So as you can see, it created that high at 1815, and then this low of about 1485. Now as you can see on each succession, as it tried to come back up, it made a lower high, and then again came up, lower high, which shows that there is no buying interest in those price ranges, because if there's were, then buyers would be accumulating the dips towards the support, and then pushing us back up into higher highs to show the momentum is continuing. So this is a distribution phase. So pretty much what happens is, you know, phase 1, all your professional experienced traders get in, and then they hold their shares, and then once it breaks out, a lot of your traders who are just now seeing that breakout, they pile on top and they push this up. And then a lot of your amateur traders who don't know no better, they'll come in right in this general area, not knowing that they're getting into the stage 3 process, which is the distribution phase, and then the overall trend fell on them and get a gap down like this, and then they're stuck. And then, like, you know, it said they'll get hope again because they see the stock is beginning to come back up. But just like I preached back in in stage 2, old resistance becomes new support. Old support, as you can see here, has now become what? New resistance. It pushed back up into that area of support, got rejected, and then continued the downtrend, and it's making lower highs on each go round. Okay, so you have to be mindful of the distribution top phase. This is when you start paying attention to the volume. This is when you start paying attention to if it's making higher highs and higher lows. This is when you start looking for certain type of patterns, like I said, the double top, the triple top, the head and shoulders, the descending triangle pattern, all these different items. Okay, but as you can see, this one was over a 2-week time span, this top, and then it finally fell. Now you do have tops that don't take that long, just like it said. I mean, it'll hit that top and then it'll change on you very fast, just as you can see here with ticker NXTD. It ran up, and I know this was on Bitcoin news, but it ran up from $1.10 all the way up here to $6.75, and then immediately you could see a lot of profit taking, and this being pushed all the way down. Right, this shows weakness, because if the buyers were interested in the stock at this price range, then this candle will actually close somewhere up here and hold that. But it showed a lot of weakness with a lot of selling, and then over a 3-day time span, the overall trend, the top just fell and it started the downtrend. So it can be a week, 2 weeks, like I said, or longer, or it could be 1 to 2 days. Okay, but just be mindful of that volume. Okay, and looking at this looks like a buying climax, as we talked about right here. Instead of the volume increasing nice and steady due to that news, you can see everybody tried to pile in on top of this price action right here, which, as you can see, was a buying climax, and that didn't leave any fresh buyers to continue to trend up, and then it started that wave of selling. Okay, now moving on to stage 4. Stage 4 is the markdown, breakdown, downtrend phase. So the 4th and final phase in the cycle is the most painful for those who still hold positions. Many hang on because their stock has fallen below what they paid for in hopes of being rescued through some miracle reversal. It is only when the market has plunged 50% or more that the amateur traders, many of whom bought during the distribution or early markdown phase, give up or panic sell. Unfortunately, this is a buy signal for smart money and experienced traders, and a sign that a bottom is imminent. But alas, it is new traders who will buy the depreciated stock during the next accumulation phase, because the cycle rinses and repeat, and enjoy the next markup. Markdown begins when price makes a lower high and no new high, as we seen here. Started making lower highs with no new high. Okay. Yeah, so markdown begins when price makes a lower high, no new high. Markdown follows distribution, which is when institutions and traders sell their inventory either for redemption reasons or simply to take profit or to change position into another stock or sector. Successful investors and traders ensure that gains are banked, and money management rules will not allow for holding a declining issue. Okay, so this is why it's very important for you to have trading rules before you enter a stock. And then it is also very important for you to try to somewhat identify what part of the stage you're in. Okay, so that way you know how to trade and handle that stage. Okay, but this is pretty much I didn't make a stage 4 chart, but as you can see here, this is the stage 4 downtrend, breakdown, lower highs, downtrend. And this is where a lot of amateurs get caught because they buy in the distribution phase, and then it moves into stage 4, which is the downtrend phase, and then they're trapped in this area with large losses. But the bottom line is the study of stock cycles will give traders the heads up on trending conditions for a stock, whether sideways, up, or down. This allows the trader to plan a strategy for profit that takes advantages of what price is doing. The entire cycle can rinse and repeat throughout different stocks. It is not necessary to predict what phase you are in, but necessary to have the right trading strategy to play the cycle you are in. This information should help you manage your risk better and learn to make the right trade at the right time. Smart money and experienced traders who recognize the different price cycles are able to take advantage of the best profit opportunities. And as you can see here, here's another chart which shows you the emotions and what happens. So as you can see, this is that stage 1, the stealth phase, where nobody's paying attention to the stock. It's still in a bearish sentiment, and smart money and experienced traders are getting their hair. And then, you know, you kind of have the little takeoff, and the institutional investors are getting in here, and you start getting the volume spikes towards the end. And this is the awareness phase where people are paying attention. Then you finally get that breakout. And then, you know, people who got in, there's enthusiasm, excitement. You know, now the public knows because it's had this major run up, and now all the amateur traders and people who don't know anything about phase 1, now they're trying to pile on, you know, on top of this. And then it turns into greed, and then it turns into delusion as you reach the top, and then there's a new paradigm, right? And then the stock drops on them. And now a lot of amateur traders are in denial because they thought they bought in at this great price, and then all of a sudden it dropped on them, and they're in denial that they're at a loss, and they don't want to accept that they're at a loss. And then they think the stock is going to return to normal, and it goes up, and then guess what it runs into? That old line of support that was up here, and it gets rejected. And then it continues to drop, and now it causes fear because now they're at a bigger loss. And then they're taking even larger losses, which causes capitulation, which is panic selling. Now they're just selling their shares at market order just to get rid of them, because now they've taken such a major loss. And then those who haven't gotten rid of them, they're just in complete despair down here, and they're probably not even looking at their brokerage account anymore. And then it returns to its mean, and then it comes back around full circle. And then your smart money and institutional investors start accumulating those shares again, and they wait for the run up. So this is a cycle that I want every trader to learn. Okay, the stage analysis cycle. Okay, stage 1 is the accumulation phase. Stage 2 is the markup, breakout uptrend phase. Stage 3 is the distribution phase, where smart money who bought in down here is now offloading their shares to amateur traders who are trying to jump into this trend, and they think they got into this, you know, made this excellent entry, and then it goes on this amazing downtrend, and now everybody who jumped in this area is stuck with large losses. Okay, if you learn these 4 phases and you can identify what phase you're in, it'll better help you trade. Smart money and experienced traders like to get in down here so they can get the run up. People who short stocks, guess what they like to get in at? They like to get up here in the distribution phase. They like to buy at the high and ride it back down to its low. Guess where breakout traders and momentum traders like to enter? Momentum traders and breakout traders don't like to enter down here in stage one. They like to enter in stage 2 when it breaks out. Soon as it breaks out of that pattern, then you get breakout traders and momentum traders who pile on top of this because they know it's going to go in the trend and they ride it up. Then you get pullback traders. As the trade is going up and it pulls back, everybody who missed that wave, they jump in. Swing traders, and then they ride it back up. So there's different types of traders who play each part of this cycle. And if you're a bullish trader who likes to buy stocks and ride them up, and you buy in this general area, then you've bought at the wrong time, because you're up here with all the short sellers who are trying to ride this down. And of course, you as an amateur trader won't be able to push this stock up on your own. And then you're going against the wave, because now you have all the short selling traders around the world piling in on top, ready to ride this wave back down. Okay, so you have to be able to identify what stage you are in. Okay, so TTM trades. Hopefully you all learned something. If this video helped you and you think it'll help another trader who's trying to learn how to trade, please share this video with them. Tag them in it. Leave a comment below. Hit that thumbs up button if it helped you out. Subscribe to the channel. Tell your friends. And I'm going to try to continue to add value to your trades and help you make money. The Discord chat link is at the bottom of the YouTube video if you want to join. We have a lot of new traders in here, and we're helping them out, and a lot of them are learning very fast. So TTM Trades, till next time, I'm out.
Houston, Tranquility Base here. The Eagle has landed.